Pleased to be here. So I'm David Chreng-Messembourg. I'm one of the founders of LeadBlock Partners, and we're a venture capital fund focusing on blockchain and digital assets. So to start with, there's a couple of things I wanted to share with you today. It's what we as investors are looking at, what we're looking for, and also effectively the parameters that we tend to observe and try to track in order to find the next big thing. So, as founders, being a founder myself, I know how tough it can be, especially in the early days and at the scaling phase. But, we all traded a stable paying job, stable life for an unstable, uncertain future. Sometimes, I tend to wonder why, we decided to do that, but effectively is to find and build the next big thing. So a couple of things I wanted to share today is our vision at the fund, because we were born in 2018 in the previous bear market. A bit more on the VC landscape, so what we're all looking at as an investor, but also what's been happening in the startup ecosystem, not only in blockchain and digital assets, but also across the board, because you need to account for the broader environment. And finally, what it actually takes and how to navigate in this current bear market. So to start with, I'm sure that you guys have seen those charts a couple of times, but what is very important here on the left one, instead of just looking at the different phases of the internet evolution, what matters to me are the different cycles of funding and growth within each and every single of those phases. So when we think about Web3, everybody is referring to anything related to blockchain or digital assets. But what you can see here are effectively some protocols. That's only the infrastructure, right? So if you think about the next leg of mass adoption, do you think that it was due to the infrastructure, meaning the telecommunication infrastructure or the TCP/IP? Do you think what made Facebook and Google so popular was simply their platform? I don't think so. So basically, going back a bit further, back in time, in the 90s, we've been all hearing that that's been the beginning of the internet. We've seen the TCP/IP infrastructure, so the internet protocol being built. But what we are not referring to enough is the capital, the massive amount of capital that has been invested by the telecommunication industry in order to build that layer of connectivity that enabled every single household and every single of us to be connected to the web. That phase was very capital intensive. It took a lot of time, took nearly a decade, but it didn't bring the mass population there. So if you're thinking about today, infrastructure layer on the internet or on the telecommunication side, whether you're talking about Vodafone or Deutsche Telekom, I think the couple of parameters that we all care about is price, coverage, and efficiency. So that's how they compete about, and it's all about market share and trying to grab as much market share as possible in order to become more efficient. What matters more, to me, when I'm thinking about the beginning of the Web3, it's been the same thing over and over again. So the past 10 years, we've seen being built the first leg of infrastructure across many layer ones, many layer twos. And they've been tapping initially into a layer of transactional infrastructure, and then they've been tapping into efficiency. After that, what you've started to see is the application being built on top of it, of the like of Facebook, of the like of YouTube. But those applications were not the one that brought mass adoption either, because the ability to build an application, the ability to build a website was very cumbersome. You had a lot of technical challenges in order to do so. The phase that I see being the layer of exponential growth was when companies of the like of Bubble, WordPress, Wix, that enabled people from product, from marketing, or customer-centric professionals to effectively come into the space, do not have a lot of hurdle to build those products for dedicated mass population, and at a very low cost. So that's the phase that I feel that we're yet due to experience in Web3 for mass adoption. Oops. So what we're doing at the fund is that we're investing in those enablers. So the fund was born in 2018, previous bear market. We've screened over 3,000 companies since then, and we've only invested in less than 1% on the back of it. So what was important for us, and the vision that we had, was that we were in the middle of that infrastructure growth phase, and we thought that for a market that was mostly retail-driven, we needed to get the equipment, the tooling, for institutions and corporates to come on board. Why those type of customers? Because they bring trust. So we've been investing into those equipment on safety, for instance, as a custodian, on the trading side for exchanges, on the analytics or the analysis, such as portfolio management systems. So all of that has been great, looking at the digital asset space and financial services. But for blockchain and digital asset mainstream adoption to happen, we cannot only stay in financial services. It has to be broader than that. It has to tap into every single industry around us. Same for payment. Imagine if payment was only condensed and reduced to financial services instead of going through real estate, retail, consumer good, and the rest. But after speaking about all of this, what does it mean for all of us as investors and founders in this landscape? So when you're looking at this chart, it's pretty terrifying for the blockchain and crypto ecosystem, but we're not isolated. So we've gone significantly down in terms of capital being injected into the space, not only in blockchain and crypto, but across the board and tech. And that has been due to several factors. So you've got, of course, the high inflation environment, high interest rate, geopolitical uncertainty and instability, and you've seen also a deceleration of global growth. So all those parameters have been reshaping the environment that we're living in, and we've seen a lot of capital being dried up. But that has not been due to the fact that dry powder isn't there. Actually, when you're looking specifically at crypto and blockchain, we've reached last year an all-time high in terms of capital being raised and dedicated to the space, close to 100 billion. And only a very small amount of that capital has been deployed. The reason why we haven't seen a lot of investment is on the back of what happened last year with the series of unfortunate events in the tech sector, but also in our own industry in Web3. Most of the funds have had to reconcentrate on their own portfolio to make sure that they had enough cash, that the challenges they were facing were contained or resolved, and that we could move forward. But that being said, 18 months of very low environment for investment is unsustainable. And that's the reason why you should be thinking that those capital from venture capitalists have been raised, and we have the responsibility and the job to deploy that capital. So we're all pushed to try to find the next big thing and to invest in it. Looking at how to navigate, so what I want to do here is share a bit of what we're thinking as investors, what we're looking for, and also what I've seen so far with my peers in the space on the startup ecosystem. So starting with the VCs, in the bear market, you tend to see that it's a relatively quiet time. There's not a lot of deals happening, and therefore, for the deals that are coming out, it gives us more time to assess those opportunities. And also, because there's this capital being deployed at the same pace, the competition is also lower, which means that simply by looking at supply-demand, valuation is also set at a reset, and we are looking for higher performance and higher KPIs. The reason why is quite straightforward. When you're in bear market, you have two uncertainties when you're investing. Number one, on the macro, because you don't know when the bear market is going to end, and number two, on the company and the founders themselves. So that's the reason why we tend to balance those risks by requesting or actually looking for higher KPIs. On the startup side, what's very important early on is to get as much feedback as possible early on from the relevant counterpart, which are your potential customers. And you need to target product market fit at all costs. That's extremely important because most of the companies that tend to fail tend to be the one that didn't meet the product market fit. It sounds obvious, but that's one of the realities of the data point. I couldn't emphasize more on the fact that you need to secure additional runway because in bear markets, everything is slower, whether it's sales cycles or whether it's raising capital. That's also a time where you have a lot of consolidation happening because a lot of companies are going bankrupt. Some others are running out of cash, are still surviving, but they can't thrive. And therefore, they're thinking about mergers or potentially being acquired. And that's an important element to consider. Last, and it concerns more the companies that are at the Series A or B round that have already found a product market fit and generated a decent level of annual revenues. But the later stage funding market have dried up considerably, and the IPO as well, which means that if you're looking at the figure that I was mentioning before here, you're actually realizing that the amount of capital being invested in later stage has dried up considerably, because if you're investing in later stages, you're tapping into an liquidity hope, which has been the IPO usually, which is not there anymore. And I think to finish off, one thing that I wanted to share with you is we as VC are always looking for the next big thing. And therefore, especially in early stage, we want binary outcome. We want to take a lot of risk. We are here to understand, assess, and value that risk, but we want exponential return. Just want to ask you one question. Can the ones that have heard of first round capital raise their hand? Okay, that's not bad. Can the one that have heard of Uber raise their hand? She's almost everyone. So first round capital, I've invested in Uber seed round, almost $500,000. And today, that's the kind of return that every single VC is looking for. That's the proper home run. $500,000 investment worth $2.5 billion. The reason why I'm mentioning this as well is today, when you're thinking about ride-hailing or Uber, it seems very obvious. You take your smartphone, you launch one of the ride-hailing app, and you just order, a cab that way. But back in 2010, if you remember, we were at the beginning of the smartphone era. Apple just launched their first iPhone. We were nowhere near. Most of the professionals had all the BlackBerry. I had a BlackBerry at that time. Now imagine ordering an Uber with your BlackBerry with the little round in the middle. I think it would be really tough. So the kind of early stage investors are taking structural bets on something that can be significantly disruptive in the market. Here they took a bet that the smartphone was going to take a lot more space and was going to become mainstream. And the second element is that they took the bet as well that the rap create a new market. So the last word I want to share with you here is we're in the bear market, things are slower, but the reason why we all left our old job that we're stable is to try to aim big, try to build something that is materially different, disruptive, and creates value for the world around us. So the advice I always have, especially for early stage founders, is you need to think big. You need to think about unlocking new market. It's not because there's no standard today that you shouldn't define them. And you should be in a position to build the next big thing. And to me, that's how you're going to be able to get funding, to hire the talent, to inspire people, and to succeed. Thank you.